Good morning. This is Tampa Home Talk, back for our second hour. Thank goodness I have so many of you in the studio this morning because I don't think my voice could make it on one of these days where I'm doing the show by myself.
You're never doing the show by yourself.
Oh, I've had times where I had to do it by myself.
You have a team of people. Like, even if we're all gone, you have Pat George in the studio.
Yes, Pat usually will jump in and help out if I'm by myself because he wants to talk to himself for an hour, really.
I do that all the time.
Well, not me.
Do you answer yourself too?
I do. I have whole conversations with myself. Do I shave? I'm like a little soul patch right now that I'm leaving just underneath the lip.
Proud of you for that.
Wife does not like it at all.
He's got like all these colors growing in there. He's got like red and dark and white.
Cinnamon and sugar, baby. Cinnamon and sugar.
Hey, Katrina.
Yeah.
You're not going to believe this, but I just got a reverse mortgage.
Did you really?
Wow.
Yes.
No way.
Well, I'm thinking about it.
You better call me, Pat.
So we're going to talk about this because there's a whole bunch of myths, right, around this reverse mortgage thing.
Yeah, the misconceptions about the reverse mortgage are still today. I mean, the product's been out for, 30 or 40 years. And
it's not the reverse mortgage it was back then.
Right. It's completely changed. It's been upgraded and enhanced. And now that FHA took it over, and most people don't realize.
So what is FHA for the person listening? Because not everybody knows what that is or what it means.
The Federal Housing Administration and HUD, which is Housing of Urban Development.
Why does that matter that FHA took it over?
Because they insure it. They insure the lender, and they also protect you against, the loss in case the lender does go out of business. Your HUD takes over and will continue the HECM or reverse mortgage. Now, when I say HECM, that's everybody knows the word reverse mortgage. But the new name for it that HUD gave it, their upgraded name, is a home equity conversion mortgage, or HECM or HECM. So when I say that, a lot of people, of course, FHA and HUD, HARP programs, everything is an acronym. So that's where that comes from. And that's the new name of the reverse mortgage. 95% of reverse mortgages are the HECM reverse mortgage.
So let's run through the old reverse mortgages,
Yeah.
right? Can we chat through what those were, and then we'll talk about how the HECM now is different?
Yeah, basically the old reverse mortgage was never federally insured, okay? It was banks just lending the money, and they actually used to go onto the title with the homeowner. It was called shared equity because they had to protect themselves. Because if they're going to lend out money and not get a payment for 20 years, they had to protect themselves, so they actually went on the deed, and that's where people today still think reverse mortgages.
Oh, the bank's going to get my house.
Bank owns my home. You can live in your home, but you don't own it anymore. So that was one of the biggest things about a reverse mortgage that was terrible. Okay, FHA took that all away. Now, I just want to make sure very clear that the new HECM reverse mortgage, the bank never owns the home.
Right.
The homeowner has 100% ownership, just like a regular mortgage.
One of the things we get to, and a lot of the concerns, right, I guess, that we hear is the person over 62, right,
has to be over 62
to get a reverse mortgage. They think, well, I want to leave something for my children, or I want to make sure my home is left for my kids. And they think just because they get this reverse mortgage that the bank automatically gets their home.
Absolutely.
And it's just not the case.
No, it's just like a regular mortgage, and you get about 50%, give or take, depending on your age, of the equity in your home. So if you're doing a refinance, you get about 50% line of credit. And if you're purchasing, you put about 50% down. So right off the bat, there's 50% equity. Now, if you don't make a payment, because that's the whole point about the HECM reverse mortgage.
There's different ways this can go, right?
Yeah, you can actually make payments nowadays. The old reverse mortgage, you never really made payments. Now you can actually make interest-only payments if you don't want accrued interest. So you have the flexibility with today's reverse mortgage, and that goes a long way with today's seniors because it allows them to pay what they want.
Here's the cool thing about this, right? Like, we had a gentleman come in. He was actually going through several rounds of cancer and was having a really hard time finding something that he liked, right? For the price points where they are. It goes back to last hour, right? If our prices start to grow, people are selling another home, maybe moving here, and the prices escalate higher than what they think they are. It gives them the option to sit on a bunch of cash and only put half down as opposed to the whole thing in cash, right? So think about wiping out all their cash that they might need for medical reasons. They're going to have to go get a loan on it anyway, if they're wiping out all their cash. So if they do 50%, theoretically, let's just say it's a $300,000 property.
Correct.
And they've got just $300,000, but instead of dumping all that $300,000 into the house and paying cash, they can buy it they could basically get a loan for $150.
Correct. See, the theory of putting all the money down on a home, because most seniors, they're retiring, they don't want a mortgage payment. So the only way to have no mortgage payment is to buy the home cash.
Right.
Well, you're putting all of your money, and sometimes that's almost all of their money down, and now they're house rich, cash poor. So the HECM for purchase now on this side, we allow them to put 50% down. The other 50% we give them, that's the mortgage, and there is no monthly mortgage payment. There's an interest rate, of course. There's no free money, and obviously we charge interest, and it's good rate. It's probably around 4.5%.
Well, I tell people a really simple way to follow it. They're all simple interest loans, right?
Correct.
So if you can think about just
There's
a
no
regular
mortgage.
mortgage payment, when you're making that payment, as that balance is going down, the amount of interest you're paying is going down.
Yeah.
Same thing is true for reverse mortgage. If you're not making a payment and the balance is going up, the interest is going to go up a little bit as well.
Right.
But what most people don't know, and this is what I tell people, like in that one example that we had, Gary, I said, look, put 50% down, hold on to your cash in case something happens, right? Or you need that money medically. And then we can give you an amortization schedule. Just follow it. Make a regular payment. It's going to amortize out the exact same way that a regular loan would. And you'll be paid off in the same amount of time.
Or they can just pay interest only. So they don't even have to pay principal. If they want to just keep that balance, whatever we gave them, $150,000, they can just pay interest only for the rest of their life. And that equity is all there's now.
But
also,
the way I'd like to explain it is because they can't get past the traditional loan.
Yeah.
But if they go into this and they go, okay, just do it like you normally would. The only difference is you can buy a $300,000 cash home or $100,000 home, and then basically only have to get a loan for $150. You're still sitting on another $150.
Right.
Then you can make those regular payments. But if something happens,
you don't have
you've
to
got
make
the
the
beauty
payment.
of not having to make that.
Everybody
payment.
likes options and flexibility. When you get a traditional 30-year fixed rate mortgage, you have no options. The bank owns you pretty much. You have to make a payment for 30 years. And when you're 75 and you've refinanced because of whatever reason, maybe to get a lower rate, you're not going to pay it off till you're 105. And you have to make a payment. If somebody passes away, there's a loss of income. If a pension goes away, so these kinds of things happen, and people don't realize that. So with the HECM program, right, the HECM reverse mortgage, you don't have to make that payment if you don't want to, and that goes a long way.
We've seen a lot of people that lose one spouse, and now they're kind of forced into selling. Where you can actually refinance so they can stay in their home.
Oh, absolutely. I've saved so many homes where they were going to, some almost going into foreclosure because we don't really credit score with this. There's not like a high credit score to get into this program.
So can they use this as a bailout option?
Absolutely. Absolutely. I've helped so many people where they were, obviously they're paying perfect. This is a couple that's, 800 credit score. They're perfect. Everything is good. Husband passes away. Pension is gone, maybe, because they don't always transfer.
He could have been the primary.
And her social is gone because one of the socials, the lower one, goes away. So you're left with only one income stream when there were three. So now all of a sudden she can't afford the mortgage. That's called a needs-based client. We're always going to help that client with our product. But the program has shifted now for more of an affluent client, that clients that have a portfolio and they're using their income from their house as another income stream. People don't realize that. There's a lot of research on the reverse mortgage over the last, I'd say probably 8 years, where it's not just the needs-based client. Of course, we're going to help that.
Now with the HECM, does it have to be for your primary home, or could it be any home? Okay.
Yeah, they were talking about having second homes, and like you were just talking in the last hour, but it's still primary because it's really for the age and place.
Right. So I was thinking about something, and the question kind of escaped me, but it was what we were talking about.
You can always plug the off-air number when you get into a...
Can you do it? My voice almost gone.
Yes. To reach Gary from Senior Lending, if you're interested in the HECM product or the reverse mortgage, you need to text HECM, H-E-C-M, to 813-377-2775. That's 813-377-2775.
Let me give you a couple, before you get into that, just a couple statistics that really will blow your mind on how good the program has come. The old reverse mortgage started in the 60s, okay? And then right around...
Which were very heavily pumped by celebrities.
Right. And then in 1989, pretty much 1990, is when the HECM reverse mortgage, FHA's version, the upgraded reverse mortgage started. But for the first 10 years of its existence, it had to fight, people not liking reverse mortgage. You think it's bad now. Could you imagine back in the 90s? So there was only 42,000 HECM reverse mortgages in the country. That's like none. That's like a drop in the bucket. The next 10 years, from 2000 to 2010, there was 1.8 million HECM loans. So it's an explosion because people are they're educating themselves. They're doing their homework.
There's rising healthcare costs and a whole bunch of things we'll talk about in the next hour when we come back. This is Tampa Home Talk. We'll be back right after this break.
Welcome back to Tampa Home Talk. This is Adam Talley with Talley Insurance, joined by Katrina Madewell, Leo Cannyn with Beryl Engineering, and Gary Garino. And today, for our 2-minute insurance tip of the week, I want to kind of harp again on what we talked about with those rental properties. Occupancy is everything, so make sure that you are talking to your insurance agent. Make sure that you tell them how you plan to use that property to make sure that you are properly insured, and price doesn't always go up if it is a rental. So just make sure that you're open and honest with them, and you'll have the right product for what you need.
Awesome.
Nice insurance tip.
Thank you, Adam. Gary,
Yes.
how did you get, you're the vice president of senior lending, Priority
20 years.
Mortgage. 20 years
This
going.
year.
We've known each other for about a decade. How did you get into this line? How did you discover the HECM line?
HECM, yeah.
How did you get this line?
It's so funny when you say the HECM, most people go, what the heck is a HECM? Because that's what I said. 10 years ago, obviously, it's almost 11 now, 2008 hit. And everybody knows in the mortgage industry, it was, everybody was shot.
The bomb was dropped.
And a lot of, my colleagues and friends, they're out of the business. They just totally got out. We found a niche, and it was the federally insured HECM credit line, okay, the home equity conversion mortgage, the new reverse mortgage. And we didn't know anything about it. I knew every product under the sun back then. And this guy came in and he said, hey, you guys do HECMs? Because I do them, and I'm really, it's a really great product. It's up and coming. And that's what I said. What the heck is a HECM? And once you learn and you do your education about this product, for the last 10 years, I'm a home equity retirement specialist in this product now. We've taken it to the next level at senior lending. And all of our advisors are specialists in this program. Some companies might do the HECM reverse mortgage as a side thing, but they don't really know the intricacies of the product. So we've taken it to that next level, and it's really, pushed us through. We also obviously do traditional.
I was about to ask
too.
if I wanted to do just because I'm not 62 and I won't be 62 anytime soon.
We do the traditional.
You do the traditional as well?
FHA, conventional, and all that.
You dabble in 203Ks, things of that nature?
Not really.
No, not really. So.
But you know who does do those? Sarah Cricky with a mortgage firm.
That is
They
true.
do those all the time, every day.
So I guess my next question is, why would I want to, let's just say I'm a senior living in my home. It's paid off. I've got my wife. We've got no real things need.
Yeah.
Why would I want to start researching this now? So when I know why I would need it in the future.
Yeah, I'll definitely give you a couple things in our booklet and on our website. We have what we call HECM versus HELOC. And everybody knows what a HELOC is, a home equity line of credit. Well, the HECM is a line of credit as well, and it competes directly with it. If you're over 62, you should never really get a line of credit at a bank, and I'll tell you why. One reason is a line of credit at a bank only lasts 10 years. Mm-hmm. The interest-only period is good for 10, and that's what happened back in 2005, 6, 7, and 8. HECM or HELOCs were taken out in this country. I mean, if you were breathing and walking upright, the bank gave you money. What happened in 2015, 16, 17, and 18 is they all came due.
It didn't take that long. They were shutting them down in 08, 09.
Right, but even the ones that still were going, and all of a sudden that interest-only payment that they were paying jacked up. It's called payment shock, and they had to, whatever their balance was, they amortized it over like 10 years. And so the payment, if they had a large balance on their line of credit, and then all of a sudden they go back to the bank, and banking has changed, and they can't re-up their line of credit.
Yeah.
The good thing about the HECM, if there is no period, it's interest only for life. It never ends.
Right.
Second thing is it's federally insured, which is good. That's obviously at a bank. It's not. Also, there is a growth rate on our line of credit. This is a pretty amazing thing. This is what I teach financial planners and CPAs, is that our line of credit actually increases every year. There's a growth rate attached to it. So let's say you open up a $100,000 line of credit at a bank, Bank of America or one of the banks. Your line is $100,000, period, for the period that you opened it. If the housing market starts to go down, they have every right to close it, freeze it, or reduce it because they are tied to the value of the home. The HECM program is not, because it's federally insured, so the value of the home is actually a moot point to us because we're insured by FHA. So even if the housing market is declining, your credit line limit is increasing. That's an amazing feature that they put with it. So you have a $100,000 line of credit, it may be $150 within about 5 or 10 years.
Is there a set percentage that it goes up, or is
It's tied to the LIBOR. So the balance on your line of credit, if you draw money that's tied to the LIBOR index, and that stands for London Interbank Offered Rate. It's just a different index that they use.
Thank you
like
for
prime
explaining.
I was going to ask what LIBOR is.
London Interbank Offered Rate. A lot of financial
It's
planners
no different
know
than
about that.
prime or T-bill. People are more familiar with some of those.
Correct. They pretty
LIBOR
much.
is actually a more slow-moving index.
Correct. And it's
I
got
like
a
it better.
cap.
Yeah.
The prime rate, if you get a line of credit at a bank, the prime, there's no cap.
Can I ask a stupid question?
Yes.
So since we're talking about a London index and we're not familiar with LIBOR, is Brexit going to affect LIBOR?
Not sure.
Okay.
I'm not too sure. That's more of a financial
Interesting.
index. Yeah.
Just wondering.
Yeah.
Because
a
LIBOR
pretty-
is a pretty widely used index because
Yeah.
it is slow. It is
So
such
slow
like a
moving,
yeah.
and a lot of financial planners would know that a little bit more on that.
I mean, if it were me and I could get just a line of credit on my home, I'd prefer if it was tied to LIBOR
Correct.
versus prime.
Right. And
But
then
it
the other
doesn't,
thing
it's
too,
not offered.
plus it's also an annual changing. So it's not every month, and it's also what they do is they average it over the previous 12 months. So LIBOR is very slow moving when you have that average, and they have a cap each year. So the rate, and I'll give you another quick little tidbit of statistics. Back in the late 70s and early 80s, I know.
I love statistics.
When mortgage rates were at 16 and 17%, I was still in high school, but the mortgage rates were that high. It was ridiculous. The highest the LIBOR index ever hit was 6.875. So even when the mortgage
Yes.
rates over here are going crazy, that's why LIBOR is a little more stable. That's why HUD picked LIBOR over prime. Okay.
Well, I know when I came into the business, Gary, in the early 90s, rates were at 12
Yeah.
for
Yeah.
conventional
I
money.
think the prime was
fathom
9
that.
or
And all the
something.
balloons of the 80s were popping. It was
Yeah.
pretty crazy. And I started out at a subprime shop. So I was like, I don't know if I want to do this.
Subprime, right? You know what they call that? That's non-QM now, non-qualified
non-QM.
mortgage. But it's the HECM credit line versus the HELOC has a lot of. Also, there's no maturity date, so they don't have to worry about that. Oh my God, 10 years down the road, I got to redo my line of credit. It's got the growth rate on the back end.
There's just no requalifying.
Right.
There's no
There's no
pressure if you
credit
can't make
score.
a payment.
Yes.
It's not like someone's going to kick you out of your home.
Right.
Some of the biggest issues that we would see in, this one lady is actually that we have right now is being foreclosed on a reverse mortgage. This is the older ones that
The
we were
older
talking
one, yeah.
about. And she was being foreclosed on for forced place insurance and not paying the taxes.
Right.
And so that's one of the new things about these reverse mortgages, which they're
financial
just not,
assessment now, yeah.
So how does that work to make sure that an older person doesn't lose their home for taxes and insurance?
Yeah, and the funny thing about that is the reverse mortgage, even back then, she didn't pay her taxes and insurance and forced place insurance. That would be true with any loan. If you don't pay your taxes and your insurance, any loan could call you due. So that's the one thing that's you have to make sure you're clear with that. It's not just the reverse; it's any mortgage.
loan. Yeah.
So now what they did is they put a financial assessment on it, which is very easy. It's basically residual income, and they make sure you can pay your taxes and insurance with this little bit of a residual test we do. And if they can do that, and easily, most Social Security income alone covers that. But if they can't, here's what the new thing is. That's called ELISA, another acronym.
Wait,
Here
can we
go.
back up for a second, Gary?
Yeah.
What does that look like? Like, do you know, for example, let's say somebody only has, I'm going to go low and say $1,000 a month in Social Security. There's one person left, the other spouse
Yeah.
has died.
Here's what it is in our counties around here is $529 of residual income. If you're a couple, that's $829. Okay, so their income minus their utilities, which is a factor we base off of square footage, and we put in the square footage, it gives us a number, computes a number, and then their bills, and that all has to be higher than $529 for single.
So if they don't have that,
Now, if they're below 529, just a little bit below, let's say they have,
residual, which is extra money left.
extra money over the 529, according to our FA, our financial assessment, then what they'll do, they won't deny you. They won't say, like a traditional mortgage, if you don't have a credit score, you're denied. They say, well, we're going to hold back a LESA, LESA, and that stands for Life Expectancy Set Aside. Okay, basically an escrow. Okay,
So
they'll hold back money.
Let's break that down. What this might look like. Let's say, for example, we've got a senior, somebody over 62.
Mm-hmm.
The house is worth $300,000.
Mm-hmm.
They owe less than $100, and whatever. Maybe they need a roof on, right? Or their insurance company's ready to cancel it because they don't have the money for the roof.
Why do we always pick on Adam?
This because he's an easy target.
Low hanging fruit.
I vowed that during this 2-hour segment I was not going to pick on
I
Adam at
wasn't
all.
picking on it, but that's a real thing.
Yes.
You can't tell me you've never seen somebody where the insurance is not renewing because they need a roof,
Right.
And
Yep.
they don't have the money.
But that's a perfect example.
So,
Do we have time to?
When we come back
I know.
after the break.
You're teasing them. I got
Well,
it.
I want to chime in on that because that's a very real scenario.
Oh, yeah, absolutely.
And so what happens if they owe under 100, the value is 300
300
or more? We're going to talk about how do we set that person up to succeed so that not only can they get a new roof and Adam can renew them for a nice policy
And
that's
stay in
even
that
cheaper.
home with no payment for the
but
rest
how
of
can
their
they
life.
stay there and also make sure they don't lose it
Yep,
to
perfect.
future taxes and insurance? When we come back right after the break, stick around and we're going to give you our off-air number again, but it's 813-377-2775. We'll give it as soon as we come back again.
Perfect.
Welcome back to Tampa Home Talk. This is Adam Talley with Talley Insurance, joining Katrina Madewell and Leo Cannyn
Ooh, that's
and
me.
Gary Garino with Senior
Lending.
Thank you, Gary. And our off-air number, if you have any questions or want to get connected with any of us, it is 813-377-2775. You can call or text 813-377-2775. And real quick, before we dive back into the mortgages, we wanted to talk about force-placed insurance.
Yeah.
A lot of people think that if they have force-placed insurance, it's actually covering them, which it is not. It is only covering the house, and it's only protecting the mortgage company. And on top of that, it's about triple the cost, right? So even in that example with the person that needed the roof, anything else like that, there is always an option out there, and it will, I promise you, it's going to be better
Why is that,
than
Adam?
force-placed.
Do you know why force-placed insurance is so expensive? Like, why can't they just get a normal policy that's cheaper?
I have no idea why that is.
Penalizing you for not
Yeah,
paying
it's a
it,
that probably
It's a
it's
big
on the
penalty,
mortgage
too.
side
Well, the
too.
bank probably has ownership interest in those companies. That's what I think.
I would assume so, and they're
Because it comes through the lender. You're right.
and I'm honestly sometimes when it happens, that's how people get in. They get in these situations where they default on their loan or anything
So
else like that.
let's before we dive into our scenario, we
yeah.
were saying what happens if somebody owes less than 100, values 300, and now we're gonna, they've lost a spouse. We want to figure out how to keep them in their home. Share a story real quick that you shared if somebody doesn't have a mortgage payment at all, where some of these loans got a bad rap, because you shared a great story on the break, and then dive into what that looks like. What's the LESA, the LESA?
Yeah, we'll talk about the LESA. So basically, you mean back on the old reverse mortgage?
Yeah, basically, someone doesn't have insurance on their home now, right? We see that where they self-insure.
Yep.
Only thing they pay is their taxes because they haven't had a mortgage for years.
Well, what happened is now we do a little financial assessment like we were just talking about, but the old reverse mortgage never had that. So you had some let's say some shady loan officers back in the day that didn't really know much about reverse mortgages and just said, you can get half of your equity, pull it out, and you don't have to make a payment the rest of your life. And some of the clients that they were doing this didn't have insurance on their home to begin with because they owned their home free and clear. And you don't have to have insurance if you don't have a mortgage, which is crazy, but there's a lot of people that can't really afford it. Lower valued homes, and they're living on Social Security. So they're like, my house is okay, I'll take the chance, and I can't afford it.
Right.
The problem is they would take out the reverse mortgage, and it wasn't, shown to them properly. And they got all the money, and the loan officer put the 1-year policy in with the loan. So it was paid through the loan. And then what happened is the next year, that policy's renewed, and the bill came to the homeowner, and the homeowner's like, I'm not paying it. I haven't paid insurance in 20 years.
Yeah,
and
but they forgot they actually have a loan on it.
Correct. And they didn't pay it. So then that's where the forced place would come. That's where they would lose their home. And then See, but that's the same with any loan, really. So that's another reason why the reverse mortgage got a bad rap.
Here's the thing, Gary. It's really about explaining stuff to people. And
Knowledge.
we do consultations with everybody, whether you're a buyer or seller. Prime example happened this week.
Yeah.
You know, we talk to every single one of our buyers, especially if they're putting a ton of money down, and we let them know, look, pay attention because, you know, the wire fraud is real.
Yes.
And so when
Yes.
you go drop off your escrow check, pick up a paper copy of your wiring instructions.
Right.
It happened this year. A smaller title company this week, a smaller title company got hacked. Our customer that was putting about 20% down got wiring instructions from Chase. And he's like, wait a minute. I picked up wiring instructions from Bank of America like you guys told me to. Very official. So it was like almost the same domain. We're looking to get the email so we can actually share that at the consultation so people can visually see it.
Right.
But we tell them that and we share so much information. Sometimes it doesn't all stick.
Yeah.
But we try to constantly let them know, look, drop off your escrow check. We don't drop it off anymore. We make them go do it because we want them to pick up their wiring instruction copy.
Correct.
And so he remembered. It triggered in his mind that we had talked about that. And that basically, hey, and then that's what we found out.
He caught it before
he caught
did
it because we talked about it. Title company got hacked. I mean, he's buying Lance did the inspection on that's probably $400,000 house. 20% down, he would have lost all that money.
Wow. Yeah. So you got to do your homework on everything.
Well, the crimes, these are investigated by the FBI. They're not very high on their priority list. They're just not.
Yeah.
But it's really important for that seller and that buyer that's not going to get their house or not going to get their money when they sell it.
Right.
So going back to, these mortgage people that did not really advise the client, hey, you haven't had insurance for a long time.
But you're going to have to continue to keep the insurance
and we're going to
policy.
include it, but you make sure you save enough money from the money you're getting to continue to pay your insurance.
Right. And then I always tell my clients whenever, you're doing it, they're paying their taxes and insurance now. So nothing changes. You're just now getting 50% of your equity to help with your living expenses and to help,
So the financial assessment they did, can someone do this even if they don't have the residual income? Like if they're not required, can they do it anyway?
Yes, if they don't meet the residual, which is you basically have to have over 529 if you're just a single person and 829 if you're a couple. If you don't have it, let's say you fall just a little short, we're not going to deny you. It's not like traditional mortgage where you're going to be denied and that's it. We'll say, okay, we're going to give you the HECM reverse mortgage, but we're going to hold back a chunk of money out of the money we're going to give you, and we're going to pay your taxes and insurance for you. So you never have to pay. Now this is
how
not
much money is that?
That's not a bad thing. I've had a lot of my clients when I told them that she didn't meet the residual, she goes, awesome.
It's a good thing.
That's a good thing. So now that's why this was started, because now they'll never get foreclosed on.
So Gary, let's do a real scenario. Let's say the person listening, they're 68 years old.
You want to do that 150 one?
Yeah.
That's
68 years old because the age matters, right?
Yeah. When we say 50% of the equity putting down on a purchase or getting out on a refinance, it's plus or minus 50%. The older you are, the more you can get, because it's based on life actuary tables and age.
Right.
The older you are, you can borrow more because your life expectancy is shorter. The younger you are to 62, the little bit less. So, but 50%, everybody can grasp
So
quickly.
62 is the minimum age.
Correct.
In this scenario, let's say someone's 68 years old, they owe $70,000. Their value is $300,000. And now they want to do this Lisa, right, or whatever, or include the taxes and insurance, that they never have to worry about that again or worry about forced place insurance. How much money can they get? How much money is a lender going to hold back?
Right.
What does that look like?
All right, so perfect. Great example. So $300,000 home, they're going to get, let's just say it's 50% because everybody can understand that. So it's $150,000 line of credit out on their home.
And let's say they owe $75,000, so you got $75 cash or $75,000 cash.
Right, 75 and 75. So basically, we're going to give them, pay off their mortgage. So now they have no monthly mortgage payment the rest of their life, or they can pay. They can pay interest only. It's their choice. That's the key that I want everyone to realize, that the HECM program gives you options. You don't
make
have
a regular
to not make
payment,
you can pay
interest
principal
only, no payment.
It's a simple interest credit line. So they have that. That's the main benefit. Then they have this beautiful $75,000 line of credit that came along with it. That's increasing every year. Remember, it's not just 75 that we're giving them from the beginning. It will increase every year by the LIBOR rate. So it's kind of like a double-edged sword. You have the mortgage that's being paid off. You now get flexible payments. You can pay whatever you want. You can pay interest only, principal interest, or nothing.
Yeah.
And then you have this beautiful line of credit for the roof, for the upkeep, to age in place and fix your home up, for things like that, for life insurance, for just supplementing your income. And that line of credit doesn't stay at 75, it increases every year, even if the house declines.
So a great plan might be for somebody that's going in, they go, okay, I'm going to get the roof. I'm going to pay off the mortgage, so now I no longer have to worry about that. I'm not going to draw on this. I'm not going to take any more money.
Let it grow.
It's just going to sit there, but I also don't have to make a payment.
Correct.
How much out of that $75,000 are you guys going to require if the bank's going to pay the taxes and insurance?
So let me give you an example. On this same one, $75,000 mortgage paid off, and they didn't meet residual. So basically, they're going to take their taxes and insurance. And
let's just say their taxes are $1,500 and insurance is $1,000.
Okay, so we'll do
$2,500 a year.
83 and divide that for me.
83 by what?
No, I mean, let's make it nice and easy. Let's say taxes and insurance are $1,200 each.
Okay,
so $100.
24.
Okay, so you have basically $200 a month for taxes and insurance. They're going to multiply that by a factor of your life expectancy. Okay, let's
What
say
is that? They're 68. Do we know what that is?
let's say
15 years.
Let's say 15 years. So we'll do some simple math here.
I love all this. All this.
Yeah, all
math
of our
and
gadgets are
spreadsheets.
kind of tied up with
I know. So
Facebook Live.
it's 200 times 180 months, because that's 15 years. So that's like $36,000. So what they'll do if they don't meet the residual, out of that $75,000 extra line of credit, they're going to hold back $36,000 of it in another escrow, the LISA, life expectancy set aside, and pay the taxes and insurance for the client. So you're not going to be denied even if you don't get the residual income.
Now, question for you with the Lisa thing, where they're just going to hold it back and pay everything for you, and that's one less thing you have to worry about. And I know as we get older, that less things to worry about is a better thing. Is that something you can do even if you don't?
Yes.
Even if you meet the residual?
Absolutely. Good question.
Or they could just write a check, right, from the line of credit and pay the taxes and insurance.
Right. It's basically they're prepaying their taxes and insurance for the rest of their life. They're using the equity in their home, $36,000, and holding it back. Now, some people say, here's the next question. They say, well, what if that runs out and I live longer than 15 years? It continues to pay your taxes and insurance.
Nice.
And they just add that to the balance.
Okay.
And unlike we didn't talk about like the after part of this loan, right?
Right.
So and that's a common question we get a lot is
question.
I don't want the bank to own my home. I still have $150,000 or more.
What are the kids going
worth
to
of
get?
equity by the
Right.
time I die? I want my kids to have my house. I'm not going to give my house to the bank. And the truth is, you're not.
No, the bank doesn't own the home. The home goes to the kids the same way. You can still have a life estate. You can still have it in a trust. The kids are still going to get the home, 100%. And let me give you the theory that most people think. Well, they go, if I take out $150,000 and my home's worth $300, and let's say they use all of the line of credit, so now it's $150,000 mortgage, Heckham mortgage, and the home's worth $300. Everybody says, well, if I live 20 years, oh my God, my balance is going to be higher than the home. Well, here's the good thing. One, it's federally insured. So if it ever goes negative, then it doesn't matter because the HUD insurance is there to protect you and pay the negative balance. It's a non-recourse loan, so you can't lose even if it does go negative. Now, the chances...
And again, this product is for somebody that wants to stay in their home.
Yeah.
That's the number one reason why a lot of people would get this loan.
Right. And the chances of it going negative are very slim because if we're adding 4.5% to 5% to the balance and the home is going up in real estate, 4 to 6 or 5 to 7%, in theory, the home and the balance are going to go up. Now, we know the housing market does this.
Right.
So let's say they die in a market like this, where it's hot, where it's way up, then obviously the kids will get all of the equity above what's owed, of course. If the home is in a down market and it's under what they owe, which would be a hard thing to do, then HUD pays the negative balance and the kids walk free and clear. So you can't lose.
So the thing about this too is unlike a traditional loan where if someone dies and the bank realizes there's a loan on it, they're going to call that note due within about 30 days.
Between 30 and 90 days.
Yeah.
With the Heckham credit line, the kids get 12 months.
So that's the other thing I like about it too.
Yeah, up to 12
They
months.
get quite a bit of time to put together a plan, figure out if they're going to sell it, keep it, refinance it.
And if anybody, obviously, there's a lot more than, to get into this. If they want to call my office, 813-490-4900, I'd love to run the scenario by them.
And I know we've talked about this a lot, and our number's a little better because we can call or text. We'll give that when we come back right after the break.
Welcome back. This is Leo Cannyn with Beryl Engineering and Inspection. I'm sitting with Adam Talley from Talley Insurance, Katrina Madewell from Tampa Home Talk, and Gary Garino from Senior Lending. And I can't believe it's almost been another 2 hours.
I know. Wow. Our off-air number, if you want to get any information on this product that we're talking about, the thing I love about Gary is it's absolutely a no hassle. I'm not going to give you any pressure approach. I'm going to give you a bunch of information. If it's right for you, you do it. If not, it's no big deal. Right. And these loans can actually be paid off or refinanced at any time. But our off-air number is 813-377-2775. You can call or text 813-377-2775. And you know what? While we're talking about it, we should just mention that, like, all of us here are hiring.
Yes. Yes. We're all hiring.
Yes.
Let's go around the circle and see who we're hiring. Adam?
We are looking for 2 positions right now. So that'd either be an agent like myself or a processor, somebody that wants to just get in the industry, learn a little bit, and help us grow.
And we are actually looking for a radio show coordinator, and we are looking for realtors, great realtors to join our team. Mm-hmm. And you can call or text 813-377-2775. Let us know who you're looking for. We'll get you connected. 813-377-2775. And Leo?
We just actually hired 2 admins. We have a new scheduled dispatcher starting. Then we have a new administrative assistant / marketing coordinator starting. So I'm excited about that. We have a new designer starting this month. So my next target is to hire a new home inspector. So we are looking for a home inspector, a fully licensed, one with 3+ years experience and over 1,000 inspections performed. Hit us up. We could give you a home.
And you're a great team. Like, you'll keep them busy.
Oh, very busy.
With inspections and make your life a lot easier.
Especially with the new marketing admin. So yeah, you can text inspector to 813-377-2775.
Yeah.
And Gary, what are you looking for?
Just let us know who you're looking
Loan
for.
officers inside and outside, so they can do their own thing and just put their license with us, or we do have an inside position, which is the leads are generated for you. So
nice.
Yeah, we have both positions that we're looking for.
So just text us if you're looking for a job or you know someone that is. It's a great opportunity. You pick your line and you're in luck. You're some rock stars looking for some good talent.
4 very different industries, all looking to bring on talent, and it sounds like we're all looking for talent that could work their way up into being higher level.
And our group's pretty fun. Like, we work hard, but we play hard. We have a lot of fun.
And the industry's good.
Yeah,
right now.
it is.
It's really...
So 813-377-2775. Save that number. Call or text or share it with someone you know looking. 813-377-2775. And that's a call or text off-air number. We're not going to put you on the air. Just shoot a little text. 813-377-2775.
A lot of 7s in there.
I know.
we should make that number even easier.
I wish it could be all 7s. That'd be pretty cool.
That's a cab. Yeah. Cab? Who uses cabs?
That'd be funny if, like, I got to go to the airport? Oh, I got to go to the mall? These are exciting. Oh, no, they want rides.
So how should we wrap up this, Gary? You have some little stories, right?
Yeah,
about
the main thing I just want to make sure that people listening understand is that it is not the old reverse mortgage. That's the key. Right off the bat,
the bank doesn't want your house.
Yes, we start off with, we call it, its legal name now, it's the home equity conversion mortgage, the HECM. And all of our marketing material is HECM because you say the word reverse mortgage. A lot of times people just, the wall comes up. They have to educate themselves. That's why you saw the boom in the HECM product. So just make sure you take that away. Talk to, call us. All of our advisors are licensed and we know the product thoroughly. I'm a home equity retirement specialist. Let us educate you on this product because the more you know, you'll see that it's not the myths and misconceptions.
Yeah, the good thing too is I've seen you actually invite the kids in where if kids have a concern and the parents are thinking about doing it, you'll talk to the whole family so that they can make sure this is a good decision for the family.
Right.
And if it's not, then don't make it. There won't be any pressure.
Right. I just wanted to end also the HECM for purchase because we're talking a lot about the credit line and pulling money out, but the purchase product, which is quite new, that one started only in 2014 and it's booming because the housing market started to pick back up and everything. So a lot of real estate agents don't know about this HECM program. And I have a perfect example. I have a client trying to buy a home in Innisbrook and it's pretty expensive, $656,000 I think it is. And she only needs to bring like $330,000. She doesn't have $656 cash. Right?
But she
still wants that house.
Yeah.
But now, so it doubles their purchasing power. So as an agent, how many times have you put somebody in the car, they tell you what their price range is, and they don't like what they see?
Yeah.
Trust me, every time.
Yeah.
So now you have an ability to say, well, listen, Here's a house. It's just a little bit more. And let me tell you, a 300,000 to 450 is a gated community.
So is there
on the water.
minimum or maximums on this? So if someone, say they're just a little short.
Yeah, FHA has lending limit, and right now it's been upped to 726, 525.
It's a pretty big
Perfect
amount.
number.
for
Great
FHA.
number, right?
Love that number.
I know FHA loves to do that, but so basically anything under that is we use the rule of the percentage. If it's over 726, then they pay the difference plus that. So
So what if it's in the scenario you talked about where it's 600,000, but they only need 100?
they only need 100 for
100,000 to buy it.
they only
To do the difference on what they want to put down and to purchase
well,
it.
with the HECM, they get the full 50%. So they can't just.
Oh, so they get it.
Yeah, they get the full 50%. Then they can pay it down.
Yes.
I'm glad you brought that up, because let's say, I'll give you an example. Let's say this example, 656, they bring 330, but they really only needed 100. So they have 230. All they do is pay down the credit line, and now they have a 230,000 line of credit increasing every year. Remember the growth rate on that. So absolutely.
No penalties on the loans.
None. Never. They can pay it off whenever they
Pay
want.
it down, pay it off. Is there any annual fees?
No, absolutely not.
Is there anything else I should be asking? Leo, anything pop in your head?
No, I just like the idea of like structuring it rather than get a whole chunk of money at once. If I was a senior, I'd kind of want to use this as like giving myself a paycheck, like every other week, just give me some money.
What about the rogue baby boomers, right? That just blow through all the cash. What about them?
Right.
Oh,
See, that's
rogue.
why
I
this.
love it.
I know, that's why this product has been researched, because the 18-year span baby boomers, they're sandwiched in between taking care of their kids and their parents.
Yeah.
They are working longer, living longer. Employer-based pension plans in this country is like less than 10%. So there isn't those anymore. They lost their money in the market. So that's why the research on the HECM program has really taken off, because it's another income stream, their home. You know, most people don't, they think of their home as, you know, back
An
in the day,
asset.
it was the old day was own the home, burn the mortgage, pay it off, own it free and clear, and leave it to your kids.
Right.
That
And that
model
still might be perfect.
That
It might
model's
be.
broken, though, for a lot of the baby boomers
Well,
today.
I think the problem is people haven't saved enough money for retirement.
Correct.
And if you don't have enough money in retirement and combine that with rising healthcare costs,
But you have a home paid off.
there's an option for you. It's
Yeah.
another option.
Absolutely.
So-
Yeah, it's a great product, widely misunderstood.
Yeah.
But that's what I'm here for.
At the end of the day, we all want more options, right?
Options.
So our off-air number, call or text any of us if you're looking to get into the field, get a job, connect with one of us. You would like to use our services. You need some help getting an insurance quote, you know, buying or selling an investment property or primary residence, pre-listing inspections, we don't talk about enough,
Yes.
or the senior lending if you're over 62. Call us at our off-air number, 813-377-2775. You can call or text 813-377-2775. And remember, love where you live, or we're going to fix it. We're so great to have 2 hours with you guys today. Thank you so much to all of you gentlemen for
Thank you for
helping
having me.
fill some of this time. My voice clearly would not have made it.
You
Have
made
a
it.
great weekend, everybody. Stay safe in that rain and in that awful traffic. We'll be back next week.